Reporting and interpreting property, plant, and equipment, natural resources, and intangibles. So up till now, we've taken a very simplistic view to property, plant, and equipment, also called PP&E. For the most part, we haven't really gone into what goes into the cost of PP&E and also how you depreciate it. We've only seen simple straight line depreciation. In practice, there's quite a few different methods of depreciation that companies use. So when we book that entry, debit depreciation expense, credit accumulated depreciation, that entry is always going to be the same. It's what amount we use, right? It's not always just divide the cost base of the asset by its useful life. Okay, so why do companies care about the amount of PP&E they have or productive capacity? Well, you want to have enough productive capacity to meet demand, so you need to have enough warehouse space and manufacturing equipment to make all the phones that customers want, but you don't want machines sitting there idle, right? Because if you invest $1 million in equipment and you only use 200 grand of it, it's a big waste of money. So there's a balance between how much you invest before you ramp up, and then at what point do you build another warehouse, buy another piece of equipment, etc. So what is the definition of a long-lived asset? So it's actively used in operations. So I think if we were to think about, if we were to think about manufacturing equipment, that is certainly actively used in our day-to-day operations. Expected to benefit future periods. Think back to the definition of an expense, right? Expenses don't benefit future periods. When you have to pay salaries or rent, you have to pay it as a result of a past transaction, right? And there's no future benefit when you pay it. But when you buy a piece of equipment, it's supposed to benefit you long into the future. There's two types: tangible, meaning you can touch it and feel it, physical substance; intangible, have no physical substance. So what are some examples of tangible resources? Land, of course. Assets which are subject to depreciation, buildings, furniture. Land is not subject to depreciation, which makes sense, right? Land never depreciates. And natural resources, mineral deposits, right? So think of gold, oil, copper, and timber, so forests. Within the intangible category, you have two categories: definite life and indefinite life. Indefinite life means sort of lives forever. We're not actually saying it will continue forever, we just don't really know how long it'll continue for. Indefinite life. Definite life means by law there's usually a restriction period. So patents might expire every 20 years, for example. Or a franchise might expire after 5 years. So these are intangible assets because you can't really touch or feel them, right? It's not like a building or furniture or a tree in the ground, but it costs you money to buy it, and it will generate revenue for you, and you're going to use it into the future. Fixed asset turnover. I think we've seen this before. This is a measure of a company's ability to generate revenue based on their investment in fixed assets. So you can compare companies based on how well they're able to use their fixed assets. Look down here, Ryanair, 0.99 versus WestJet, 1.76. WestJet is almost double that of Ryanair. So WestJet's able to use its fixed asset base to generate a lot more revenue. The calculation is very straightforward. It's just sales revenue divided by average net fixed assets. All right, so how do we record the acquisition costs? To acquire something just means to buy it, right? When you acquire your laptop, you go to the Apple store and you buy it. So it doesn't only include the purchase price, right? How much you actually pay on the invoice, but it includes all expenditures needed to prepare the asset for its intended use. So we'll show you some examples actually, but you have the purchase. If you were to buy a building, you have the purchase price of the building. What if you have to renovate it or repair it to get it up to shape, right? You have to pay legal and realty fees, title fees. All of those costs get what's called capitalized, meaning we debit the asset, okay? you might think, well, why don't we debit the building here, the purchase price, debit the PP&E, and then for these, why don't we expense them? Because they look like expenses, right? Repair costs, legal costs, title fees. The accounting standards say all of these costs get grouped into the acquisition cost of the building. Why do we care? Right? You're thinking you're still paying the money, who cares? Well, if you're capitalizing more in a year, that means you're expensing less in that year. And you're going to depreciate more every year because you have a higher acquisition cost, which forms the basis of depreciation, right? It's all timing. Over a 10-year period, that asset will wind down to zero. It's just what you have to recognize as an asset first versus an expense first. If you have equipment, you have the purchase price, of course. You also have installation costs. You might need to hire a specialized team of people to install a complex piece of machinery. Right? You might need to modify the building to install the equipment. You might need to knock a hole in the wall or pour some concrete foundation or something if it's a big piece of machinery, right? Transportation costs. If you have to pay for shipping to have that shipped from the warehouse of your supplier to your warehouse, all of that gets included in the acquisition cost, right? Land, purchase price, and then a lot of sort of commissions. And I mean, we don't need to know each of these. You just need to understand that costs which appear to be an expense can actually be capitalized. Capitalized meaning the debit goes to the asset as opposed to the expense. Land is not depreciated. So this is really nothing new here. WestJet buys an aircraft. Either they pay cash or they pay with a note payable, right? Common shares, I hope I don't need to re-explain this to you guys, but again, you know, we can, so if you were to think of the purpose of common shares, it's ultimately we're giving away ownership in the company, potential control in the company, future economic benefits in exchange for cash today, right? If we were ePhone, we had done, let's say, one round of financing, all of us put in $20 or $200 a piece, and we all raised money, that might have been enough to buy us our first piece of equipment. And if we wanted to buy a second piece of equipment, we could go and issue more shares, go to the Econ 101 class, issue more shares, take that cash and use it to buy another piece of equipment. Okay, so shares are sort of a source of financing, right? So, as an example, a company can actually pay with shares. Rather than going to the market and saying, I'm going to issue shares, take that cash, then I'm going to take that cash and buy the asset, you can go to the person who's selling you the asset and say, well, I don't have cash, but I'll give you shares of my company. This is what a lot of startups do, right? Startups pay their employees with options, stock options. That's the same as saying, instead of giving you cash, we're going to give you shares, right? The credit, you still have the equation, the accounting equation in balance, because your credit, rather than going to cash, goes to common shares. So this creates a bit of a problem, because this is what's called non-cash consideration, okay? So in a cash transaction, it's really easy to know the amount, right? There's a selling price for the aircraft, and you're giving up a certain amount of cash. In this case, the example is $75 million, right? So let's say, for example, the aircraft is maybe a couple years old, so you're not really sure exactly what it's worth, right? There's no like MSRP. Same way if you're buying a used car, it's in a range, right? It could be anywhere from 10 grand to 15 grand for the used car, right? Depends on the mileage. You might look at what other cars are selling for. It depends on the history. So you don't really know exactly what the aircraft is worth in this case. But if you were to pay cash for it, if you were to pay 75 million of cash, the accounting standards say, you don't go and say, oh, well, I bought this aircraft, which I think is only worth, or which I think is worth 80 million, and I only paid 75 million for it. So I'm going to capitalize it at 80 and credit cash for 75 and credit a gain for 5. You're not allowed to do that, okay? The acquisition cost is based on the cash paid for it, okay, or the consideration given up. If you give a note today saying, I promise to pay you $75 million tomorrow, that's considered the purchase price. So the problem is, you might have an equation where you have two unknowns. In this case, you don't really know what the aircraft is worth, and your common shares, it's not always clear what those are worth. If you're a publicly listed company, you can go to the New York Stock Exchange or the TSX or Google Finance and say, one share of Google or ePhone is trading for $100 a share. We gave up 10 shares and therefore the purchase price is $1,000, okay? Because you know what the value is. If you're a private company, you don't know what your shares are worth. You might have an estimate, you might have a ballpark of, we think this company is worth $1 million, but it could be 800,000, it could be 1.2 million. So the accounting rules say you still have to account for the transaction somehow, but you have to record at the current market value of the consideration given or the current market value of the asset acquired, whichever is more clearly evident. So in this case, we'll say that WestJet is public, okay, and they gave up 1 million common shares at $50 a share. You and I could have bought a share of WestJet that day for $50. Pretty fair to say that these shares were worth $50 a piece. So what did WestJet really give up? They gave up 25 grand of cash, but they also gave $50 million worth of shares. It's almost as if they went to the public market, issued 1 million shares for $50 a piece, got the $50 million in cash, and then gave that $50 million of cash to Boeing, right? Instead of going through all that hassle, they just said, here's 1 million shares, Boeing, plus $25 million of cash. Even if Boeing thinks that the plane was worth 70 million or 80 million, from an accounting perspective, it's more easily to measure the consideration given. The consideration given. Therefore, we record the acquisition cost of the aircraft as the total of the value given, meaning the cash and the common shares. Acquisition by construction. So again, think of if you are a developer, right? Or let's say we're building our own warehouse, right? Let's say we have the internal capability, we have a few construction guys on staff who can build us our warehouse. So how do you account for those transactions? You might think, okay, well, if I'm paying for all these supplies, if I'm paying the construction workers' labor, that all sounds like expenses, right? Based on what we've seen to date. But actually, the asset cost, meaning the debit goes to the asset, if you're constructing a long-lived asset, all materials and labor traceable to the construction. Traceable just means directly applicable to, directly attributable to, right? Maybe the CFO's salary isn't directly traceable to the building of the warehouse or whatnot, but all of the construction workers, all of the bricks and mortar that you have to buy, all those supplies that might sound like an expense are actually capitalized. We debit the asset. Overhead. Corporate costs. So you might allocate a portion of all of the costs of running the business to building this warehouse, or because you couldn't build the warehouse without those underlying, you need an accounting function, you need to pay insurance, you need to have sales and marketing staff, right? You have all this going on in the background to run your day-to-day operations. It might be appropriate to allocate some of these costs to the construction. And here's an interesting one. Interest on debt incurred during the construction. If you take a construction loan, okay, so you go to the bank and say, can you help finance the construction of this asset? They say, sure, of course we're going to charge you interest. We've always seen interest treated as an expense, debit interest expense, right? Credit interest payable or credit cash. In some cases, you actually capitalize the interest until the construction is complete. Okay, so all this is to say it's just reframing the transaction from is this an expense to is this an asset? That's the only difference here, right? The underlying substance is pretty similar, right? We're still paying people, we're still going to the bank to get a loan, we're still paying interest. It's just how we treat that for accounting purposes. All right, acquisitions as a basket purchase of assets. So the reason we call it a basket purchase is because if you go to the grocery store, you have a basket with a few items in it, right? So the problem here is oftentimes you don't buy or price an acquisition piecemeal. You don't say, I'll give you $1 million for the land and 300 grand for the building. You say, I'll give you 1.3 million for everything. So the total cost of a combined purchase of a land and building is separated on the basis of their relative market values, okay? So here's an example. WestJet purchased land in a building for 300 grand, cash. The appraised values, appraised meaning you have an independent third party come in and estimate the value of the land in the building, right? So there's real estate appraisers, there's companies and people who do this full time. And they say, well, we think that the building is worth 189 grand and the land is worth 126 grand. Okay, so the question is, how do we allocate this purchase price amongst those two? Well, the problem is, if you add the appraised values, 315 grand is the total, but we only paid 300 grand. So think of the journal entry, right? You have a couple of options. One is you got this land and building, we'll call it PP&E, for 315. You paid cash of 300, therefore gain of 15, right? That's sort of a reasonable thought process. This is called a day one gain, but you're not allowed to do that. The accounting rules say you paid 300 grand in cash. The consideration given up is kind of the most obvious, the most independent metric here. So we're going to say that the PP&E is worth 300. And you have to credit cash for 300. Okay. So the problem is we break out this PP&E into land and building. So all we do here is take the relative appraised values of the land and the building. Land represents 1/26 of 315 or 40%. Building represents the other 60%. We multiply by the purchase price, right? So that's going to be 180 and that's going to be 120. And that'll get you to 300. Here's the journal entry. Okay. Repairs, maintenance, and additions. So it might seem obvious if you take your car to the mechanic for an oil change and one of those new timing belts or whatever, that's a repair, right? You don't think your car's gone up in value or it's going to last any longer, right? It's kind of standard maintenance. What if you do a really big overhaul on your car, right? What if you replace the interior? I don't know much about cars. What if you swap out the engine for a new engine? What if you get a new paint job? Like really just completely revitalize a car and spend a ton of money. That sounds more like you're really extending the life of the car. You're improving the value of the car, right? So those are two extreme examples. It's not always that obvious in practice. When you're expending money related to an asset, is it repairs and maintenance, ordinary repairs and maintenance, or is it an addition or an improvement to the asset? The reason we care about the substance of the transaction is because of how it's treated. Ordinary repairs and maintenance are expensed. The debit goes to maintenance expense. Additions and improvements get capitalized. You debit the asset. You actually debit the PP&E. So there's some substantive tests or identifying characteristics. Okay. Ordinary repairs and maintenance only maintain a normal operating condition, right? So your car doesn't fall apart, you need to get the oil changed, right? You might need that timing belt changed. You might need new tires or whatnot, right? Does not increase productivity, okay? Productivity may be measured by how long the asset will be able to generate revenue for you, or how much revenue it will generate for you, right? How many units it'll produce per year, for example. Does not extend life. And these ordinary repairs and maintenance are usually recurring in nature and involve small amounts at each occurrence, right? Your oil change might be, 50, 60 bucks. As a function of the total cost of the car of 10 grand, that's pretty small. Additions and improvements, or extraordinary repairs or betterments, are major overhauls, occur infrequently, increase efficiency, and extend useful life. So those are the two big tests. If you determine that prior to you making these changes, the asset was going to last for 5 years, and you make these changes, and now the asset's going to last for 8 years, that sounds to me like you've extended the useful life. Or maybe you've increased the efficiency. Maybe it's still only going to last 5 years, but it's going to produce 30% more phones for you, right? Because you've doubled the number of timing belts or something on it, right? So it can produce faster. And they usually involve large amounts of money. So it's a spectrum, right? It's not as if you can say with 100% determination binary 0, 1, ordinary repairs and maintenance or additions and improvements, but you can you have to understand the fact pattern and say, based on your judgment, it looks like this is more of an improvement than it is an ordinary repair or maintenance. Think if you're a CFO and you want to improve assets and improve net income, what are you going to do? You're going to say all your maintenance and repairs are to be capitalized as an asset, right? If you don't want to pay tax, you want to write everything off, so you have a lower tax bill, meaning you need lower net income, you're going to expense everything, right? So those are two extreme examples. Probably you're somewhere in the middle. This just repeats what I said. Okay. Now, you can spend a lot of time, especially if you're a company with really big operations and a lot of kind of tangible physical assets that you're constantly repairing and replacing. This can take up a lot of time. So many companies have policies regarding the expensing of all expenditures below a certain dollar amount. So they might say any money we expend in relation to this equipment that's below $2,500, we expense. Even if in theory you could argue, oh, it extends the useful life or it makes the asset more efficient, because it's so small, we say it is not material. Okay, we care about what's called materiality, meaning is it important? If you're a $1 billion business, does anyone care about $2,500? You don't want to get stolen from you, but from a reporting perspective, if the company made $1 million of profit or $1 million 2,500 profit, you'd be indifferent as an investor, right? You're just going to round that off to zero anyway. So this is pretty commonplace to get around having to assess every transaction. All right, depreciation, nothing new. Cost allocation process that's systematically, meaning there's a system, and rationally, meaning it's supported in reason, in reality. It matches the acquisition cost of the assets to the periods benefited by their use. So you've seen this before, right? Eventually, all depreciable assets are fully depreciated, right? Your delivery truck, your warehouse, they're only expected to last for a certain amount of time. That debit moves from the asset to the expense. So the asset value comes down by virtue of crediting the contra asset, accumulated depreciation. And the expense, every year you recognize that depreciation expense, right? This is consistent with the matching process or matching principle, right? Where you have to match the expenses to the revenues that they generated. Okay. Notice how we maintain a separate account for each category, right? Aircraft, less accumulated depreciation. Buildings, and then other assets. Remember that the carrying amount is referred to as the net book value, and that's just the historical cost minus accumulated depreciation. And remember that the carrying amount is not equal to the market value. We're not saying we can sell these aircraft for $1,844 today. It's possible that we'll sell it for less or more. Unless we try to sell it to someone, maybe get some bids in the door, we won't know how much we can sell it for, right? Accounting doesn't say we expect this to be the fair market value. What we're saying is there's still $1.8 million of cost to allocate for these aircraft. Okay, so here's something you guys won't have seen before. These are 3 alternative depreciation methods. There's a 100% chance that all 3 will show up on the final. So you'll need to know how to calculate these. There's straight line, which we've seen before. That's the simplest. All you do is take the useful life or the historical cost of the asset divided by the useful life. That gives you an annual rate, right? There's a second method called units of production and a third method called it's accelerated. You'll see why. It's the declining balance method, okay? We also need one more input. For now, all we've seen is the acquisition cost. So you bought the equipment for 10 grand, and the estimated useful life, meaning it's going to last for 3 years. We also now need to estimate what's called the residual value. Residual just means left over, okay? And the theory here is assets never really depreciate to zero. Usually you'll sell it for scrap, or you'll sell it once it's kind of all beaten up. Someone's going to want it from you. You might get $1,000 out of it, right? The same way most people don't drive their cars until the car literally doesn't work anymore. Usually they'll sell it, they'll get a few grand for it, they'll trade it into their dealer. That's called the residual value, right? So you'll see why we need to know what that is. So let's say for the delivery truck, it might be 1,000. Also called salvage value. You might be able to sell equipment for just scrap metal or something, right? Someone might pay you for it. So this is an expansion of our traditional straight line method. This is the first method. Traditionally, all we've done is cost over useful life. What we actually have to do is cost minus residual value as the numerator divided by the useful life in years. So if at the beginning of the year WestJet purchased ground equipment, so ground equipment in an airport is, those little cars they have on the tarmac that take the people out and all of the luggage in and out of the airplane. So that's ground equipment, right? So WestJet purchased ground equipment for $62,500, 3-year useful life, and an estimated residual value of $2,500. Meaning at the end of 3 years, we're going to be able to offload this to maybe like an airport in like rural Alaska that is willing to buy cheap used ground equipment for $2,500. So the important thing here is notice that this total here is 60, meaning we're only ever depreciating up to the residual amount, right? We don't want to over depreciate, because then we're going to realize a gain at the end of the period. The goal, or at the end of the 3 years. The goal here is to try, and it's never fully accurate, but to try to say, what do we expect to get for it in 3 years? Meaning, how much can we depreciate up until that point, such that if we sell it for our residual value, there's no gain or loss. Remember how a gain or loss arises? The gain or loss on sale of a long-lived asset arises where the amount of money you receive, the proceeds from the asset, are greater or less than the carrying value. The way we've set up our equation, we're saying that we're going to depreciate 20 grand a year, such that at the end of the 3 years, the carrying value will be equivalent to the residual value of 2,500. So this depreciation expense of 20 grand per year is just the 60 over 3. Right? Nothing new there. And we can see this schedule. This is called a depreciation schedule. You'll actually need to know how to prepare these because it'll help keep track for your accelerated method, which is method number 3. But all this does is sort of keep track of your balances, right? Each year, you have 20 grand of depreciation expense, such that the total over 3 years is 60. The accumulated depreciation, so this is sort of the journal entry here, the debit and the credit. But this accumulated depreciation balance is a running total, right? We go 20 plus 20 plus 20 gives us 60. And the net book value, notice how it goes from 62 to 42 to 22.5 to 2,500, which is the residual value, right? So this is just a nice sort of way of saying, if we book 20 grand a year of depreciation, we're going to have this carrying value of 2,500 at the end of the 3 years, which should be equivalent to our residual value. More companies use the straight line method of depreciation in their financial reports than all other methods combined. That's just so easy to do, right? All you need to know is the useful life. Units of production, or the activity method. So this is very similar to the straight line depreciation method. Notice how the numerator is the same. We want to figure out how much cost do we have to allocate such that once we're done depreciating the asset, its cost will be equivalent to the residual. Okay? But the denominator in this case, rather than being years, is your life is measured of units of production. Okay? So going back to this example, WestJet purchased ground equipment for $62,500 cash. In the previous example, we estimated this ground equipment would have, oh, sorry, did I skip it? Would have a 3-year useful life, okay? In this example, rather than measuring the number of years, we're measuring the kilometers driven, okay? So we might know that we drive about 33,000 kilometers a year, but if one year we do 50,000 kilometers, and the next year we do 25,000, and the next year we do 25,000, our straight line depreciation wouldn't accurately reflect how we're using the asset, right? Because we're using more of it up front and then less of it in the other 2 years. So what we're doing here is, here I'll show you the example. So we calculate a depreciation rate per kilometer. The straight line depreciation is actually this method simplified because we're just presuming that our unit is years, right? Rather than saying 20 grand per year, we're saying 60 cents per kilometer, okay? So the next question is, we have to do one more step. How many kilometers did we drive this year? This is applicable to a car as well, right? You might think of a car, yes, it has a useful life in years, but it also has a useful life in kilometers, right? So if we say that this asset depreciates by 60 cents per kilometer and we drove 30,000 kilometers in the first year, that's 18 grand of depreciation. That's different than the straight line, which booked 20 grand of depreciation, right? The problem with this method is you need to keep track of how far each of these ground trucks drive. It might not really be worth it, right? It's a big headache to keep track of all that. So notice here how we have, instead of each year, we have to keep track of the kilometer totals, right? 30 in the first year, 50 in the second year, 20 in the third year, total of 100 grand. So your depreciation expense is just this number times 60 cents. Your journal entry, the debits and credits are the same. Debit depreciation expense, credit accumulated depreciation, right? But notice how the balance moves a little bit in a different way. It goes from 62.5 to 44.5 to 14.5. And then down to 2,500. In the end, we get to the same result. We still depreciate 60 grand. It's how we depreciate it. This is going to impact earnings for years 1, 2, and 3, right? So we want to make sure that earnings are accurately stated in years 1, 2, and 3. The units of production method can be used for really anything. You can measure kilometers. You can measure how many phones this equipment's going to produce. Right? You can think of it as sort of service hours. How many hours can we keep the machine running before it wears out? More accurate than straight line, which just assumes every year just write off a certain portion of it, but it's harder to measure. And there's more estimates, right? What if the equipment ends up lasting for 120,000 kilometers or 80,000 kilometers, right? Now you start running into problems. The third method is called accelerated depreciation, and I'll show you why it's called accelerated. The theory here is that most assets are very productive in the early years and are less productive in the later years. And by productive, it could be they produce a lot, but also you're going to generate the most revenue in the early years of an asset, right? If you have special phone manufacturing equipment that's going to last for 3 years, your first run, you're going to make maybe 50% of all your revenue that you'd ever generate from that equipment. Problem is the equipment gets older, you can't generate the phones that are as high end anymore, you might not generate as much revenue in the second run. And then in your third run, you're now on sort of, Apple has moved way forward with their phones, you're still using this old equipment, you're not going to be able to generate a lot of revenue with it. So the goal here is to match. It's sort of a compromise between the units of production and the straight line where you have higher depreciation expense in the early years and less depreciation expense in the later years. Your total depreciation expense across the period is still the same. It's just how you allocate it across the periods. Okay, and this also, in the early years, think of when you drive a car off the lot, right? It loses like 20% of its value when it has 10 kilometers on it. Right? It drops off really fast and then it sort of stabilizes, right? And then declines just a little bit every year after that. So in the early years, you have high depreciation expense under this method and low repairs expense. And then in the later years, you have low depreciation expense and high repairs expense. That makes sense, right? Just like a car. So how does this method actually work? So we modify the straight line method, and we turn it from a linear to a, I'm not sure what the technical term is, but it's curved. And I'll show you what I mean by that. Anyone in math here can tell me what the technical term for this function is. But what we actually do is we take the carrying amount, okay, the cost minus accumulated depreciation, okay, that's different than our straight line method, which only looks at the cost. Same for our units of production, only looks at the cost. We look at the current carrying amount, okay, and we have a declining balance rate. In this case, so the most common you'll see is what's called a double declining. Meaning, and this is just a factor, so if you see a 2 here, that means it's double declining balance, DDB. I want to show an example, and we also ignore residual value. So this is by far the most complicated method to implement. That means I can ask the most about it on the final and generate the most marks from it, right? So let's look at, let's put some numbers to this. So same example, WestJet, purchase equipment for $62,500, useful life of 3 years, estimated residual value of $2,500. Calculate the depreciation expense. So this is showing 2 years worth. So in the first year, our carrying amount is just the cost. Why is that? Because in the beginning of the year, there's no depreciation, right? This is a new asset. So the cost is equivalent to the carrying amount because accumulated depreciation is 0. Notice how instead of depreciating under the straight line method, we would have done 1/3 per year, right? Under this method, we do 2/3. And that's just because the 2 is sort of standard. I'll tell you if it's a factor of 2 or 3 on the final. It'll probably be 2. But the 2 is always in the numerator there. Okay? Notice how our first year of depreciation, we're writing off 41,667. In the other methods, we wrote off, I think it was 18 in our first year for the units of production, and it was 20 under the straight line method. Under the accelerated depreciation method, we write off 2/3 of the asset in the first year alone. So you can see how this can create vast distortions in earnings, right, and in assets. How does year 2 look? Well, year 2 is a bit more complicated. We can't simply depreciate this asset by 41,667 every year, because by the middle of year 2, we won't have anything left, right? We're over depreciating it. So what we do is we actually say, what's the remaining amount to be depreciated? We've already depreciated 41,667. That leaves us with, what is that, about 21 grand to depreciate, right? The 62.5 minus 41,667. This is the carrying amount. And we apply the same 2/3 factor. Our year 2 depreciation is only 13,889. So what's actually happening to the depreciation expense? I'm going to do a little graph here. Here's year. Here's depreciation. It actually follows a pattern like this. That's meant to be nice and curved. What's that called? Not sure. But it's the opposite of, or not the opposite. Straight line is like that. It's linear, right? So next year, all right, so going back to the example. So we've depreciated this asset by 2 years. The carrying amount is 69.44, right? Year 3 comes along and we apply the same methodology. We say, what is 69.44 times 2/3? That gets us depreciation expense of 46.29. Great. What we're saying here is our total depreciation for the 3 years is 60,185. That's a problem because we estimate a residual value of 2,500. And in fact, if we book this entry as is, the 46.29, what we're saying is We expect residual value to be 2,500, but the carrying amount is 2,315. That's going to be a gain when we sell it, right? So this method, the way it works is your final year, this number is actually called a plug. Okay? You don't calculate this number 4444 by taking 2/3 of the carrying amount. What you do is you look at the residual value, and then you look at the current carrying amount, and you say, what does the amount of my depreciation expense have to be this year such that I end with carrying value equivalent to residual value? In this case, if you book debit depreciation expense, credit accumulated depreciation for 4444, this carrying amount is going to decline from 6944 to 2500. So those are the three methods. They will be tested 100% in a very similar fashion. It's very hard without building one of these tables for yourself. It's really hard to keep track under the accelerated depreciation method. So I'd recommend learning how to make one of these tables. Okay, for units of production, it's pretty straightforward, and for straight line, it's easy, right? Okay, changes in depreciation estimates. So up till now, everything has been estimated, right? We say we think it's going to last for 3 years. We think it's going to have some residual value. We think we'll be able to produce a certain number of units, right? Therefore, depreciation itself is an estimate. The problem is estimates can change. Okay? And that's because over the life of an asset, new information can come to light indicating that the original estimates were inaccurate. If you bought a car expecting it to last for 100,000 kilometers, turns out it's super efficient, and you think it's actually going to last for 200,000 kilometers, you now have to sort of reassess. If you were budgeting to buy a car 2 years from now and you realize you're now going to have this car for another 6 years, you can use that money in a better way, right? The same goes for businesses. If they think equipment is going to last them longer or shorter than they thought it would when they first bought it, they need to reallocate their funds. The accounting statements also need to reflect that. So how do we adjust for estimates? The carrying amount, less any residual value at the date of change, is depreciated over the remaining useful life. I'll show you an example of this. Okay, so we care about what the carrying amount is at the date of change and what the residual value estimate is at the date of change and the remaining useful life at the date of change. So what we do is we sort of rebase. We say we don't care what happened in the future. We look today, we say, okay, we have a carrying amount. We have a new estimated useful life and a new residual value. We sort of reset the straight line depreciation calculation. Rather than doing 20 grand a year, we reset it to today based on our forward-looking estimates. So here's an example. WestJet purchased an aircraft for $60 million. The aircraft is depreciated using straight line with a useful life of 20 years and an estimated residual value of $3 million. Okay, so we know we're depreciating $57 million over 20 years. In year 5, WestJet changed the estimated useful life to 25 years and lowered the residual value to $2.4 million. That makes sense, right? We're going to use it a little bit longer, and therefore we're going to be able to sell it for a little bit less. Calculate depreciation expense for the 5th year using the straight line method. So remember, we need to sort of put ourselves in that year and say, going forward, how much more do we have to depreciate? How much have we depreciated to date, and how much more do we have to go? So up until here, this is all standard stuff, okay? The acquisition cost of 60, accumulated depreciation for years 1 to 4, 2850 per year, that's just the 57 divided by 20, right? $28.50 per year times 4 years. So we would have booked this journal entry 4 times. And now we're at the beginning of year 5, and we realize that the remaining carrying amount is $48.6 million. Okay, we haven't changed what the carrying amount is, right? What we're saying is, well, the residual value was based on $3 million. Now it's only $2.4 million. So we actually have $46.2 million left to depreciate at this point. Divide by remaining life. As at this point, we thought we would have had 16 years left to depreciate it. Because the useful life of is 25 years, and we've used a full 4 years, our remaining life is 21 years at this point. It was 16 years, right? You can think of this also, rather than, you can look at this here and say, we started with 20 years, we went to 25 years, that's plus 5 years, right? So now we're depreciating 46,200 over 21 years, such that the revised annual depreciation is 2,200, 2.2 million per year. If you take 2.2 million per year times 21 years, you're going to get 46.2 million of depreciation. If you subtract that from your remaining carrying amount of 48.6, you're going to get your residual value of 2.4. So all it's saying is you're rerunning the same calculation that you would have done when we acquired the asset, except now you just need to sort of rebase and say, how much longer is the asset going to live for? What's the new residual value? What's the current carrying amount? Any questions on that? Okay, asset impairment. Assets sometimes won't be able to, okay, so I mean, we buy assets with the intention of generating revenue, right? Sometimes an asset won't even generate enough revenue to pay for itself. This happens, right? Casualty meaning like damage, obsolescence, obsolete. If we have this equipment that's specialized to only manufacture MP3 players, how do you think we're going to do? Probably not very well, considering nobody buys MP3 players anymore, right? That asset is probably obsolete. There's still, I mean, we can still sell it for scrap metal. It could still produce MP3 players if there was any demand for them, but we're not really going to use it. Lack of demand for the asset services. Okay. I'm not going to go too much into this, but there's technical accounting tests, okay? So you have to determine if an asset has suffered a permanent impairment, okay? So when does an asset suffer permanent impairment? When events or changed circumstances cause the carrying amount, we know what the carrying amount is, of these assets to exceed their recoverable amount. And the recoverable amount is defined as the higher of its value in use or fair value less cost to sell. So this is highly technical. I don't expect you guys to memorize all this, okay? If the carrying amount is greater than the recoverable amount, the asset is impaired. What does that mean? In general, when we buy a plane for $10 million, you expect to recover $30 million in revenues from it, right? Why else would you buy the plane? You're going to use it. I mean, you're going to depreciate $10 million. You're going to use it. But the hope is you generate more revenue than the cost such that you make a profit, right? That's how all businesses operate. If we just bought a plane for $10 million and we realize, customers aren't really flying on it, we're only ever going to realize $8 million of revenue from this asset. Okay, so the accounting rules say the recoverable amount, so that's value in use. Value in use meaning the value to you as the user, the future cash flows of the asset. If the recoverable amount is below the carrying amount is therefore greater than the recoverable amount, and you're impaired. Fair value is how much you could sell the plane for. Let's say you bought the plane last year for $10 million, and then you realize no one's using it, so you go to try to sell it, and people are only willing to give you $5 million for it. Well, that's not very good either, right? The fair value is less than the carrying amount. So if either the fair value less cost to sell, so this is the technical accounting term, all you need to know is the fair value. And value in use is known as VIU, is greater than the carrying amount, the asset is not impaired. As long as you expect to generate more revenue than it costs you for this asset, or if you think you can sell the asset for more than it cost you, it's not impaired, which in 99% of cases is true. It's the odd case, right? It's a rare occasion that assets are impaired, but they do get impaired sometimes. So here's an example. I just made this same example, but WestJet owns a plane with carrying value of $50 million. Passengers don't like the plane and are choosing to fly with other airlines. We realize we're never going to earn $50 million of value from the asset. Okay, so all you need to know for the final for this is just that assets can be impaired, and they're impaired if the carrying amount is greater than the recoverable amount. Okay? But I'm not going to ask you to do an impairment calculation because that's complex. Disposals, nothing new. You can sell, trade in, retire, meaning just drop it in the garbage. Sometimes there's fires and accidents. So up until now, we've always done examples of we disposed of an asset with carrying value of 10 grand, proceeds of 12 grand or whatnot. So the problem is if you're in the middle of the year and so companies only book that depreciation entry at the end of the year, right? If you're in the middle of the year and you sell the asset, it's actually half depreciated. So we actually need to update depreciation to the date of disposal to determine the carrying value as of that date. So this is no different. Journalize the disposal. So first we have to record the journal entry for depreciation, if this is partway through the year. And then we recognize the gain or loss. Nothing new here. We've been seeing this since some of the early classes, right? WestJet sold aircraft for $11 million in cash at the end of its 17th year of use. This would be different if it said beginning of 17th year of its use. Okay. The aircraft originally cost $30 million and was depreciated using straight line with zero residual value and a useful life of 25 years. The amount of depreciation recorded at the end of the 17th year to bring depreciation up to date, 1.2 million. So that's just your standard calculation, nothing new. We need to update the accumulated depreciation such that our net book value is 9.6 million, and that'll give us a gain. Right, this is nothing new. But again, if you sold it halfway through the year or 1 quarter in through the year, you need to book depreciation for that 1 quarter and then calculate the gain. This is, again, nothing new. You guys have seen these journal entries since like week 2. Acquisition and depletion of natural resources, oil, coal, and gold. So what defines a natural resource? They are extracted from the natural environment. Okay. The total cost of the asset, remember what we debit is the cost of acquisition. We might have to buy the plot of land, right, where the mine is or where the oil field is. But it also costs us a lot of money to explore it and to develop it. Okay. Again, those exploration and development might sound like expenses, right? You're paying people, you're using supplies, you're digging in the ground, you're using some equipment that's depreciating. But all of that goes into the cost of the asset, meaning we debit the asset as opposed to debit the expense. On the financial statements, you'll see a non-current asset. Now, it's not called property, plant, and equipment because it's a natural resource environment, but it functions The mechanics are very, very similar. It functions the same way. The total cost, so this total cost here gets allocated the same way PP&E gets allocated over the periods benefited by the means of depletion. So this oil field won't last forever. We're going to generate a certain number of barrels of oil or a certain number of ounces of gold, right? Very similar to the units of production method. This calculation is exactly the same as units of production, right? Except instead of production, it's recoverable units, however you might measure the unit. Ounces of gold, tons of coal, barrels of oil, etc. The acquisition and development cost, that's a little bit different, right? You need to know that all the costs incurred to get this mine up and ready to start extracting goes into the cost. We don't expense it immediately. It does eventually get expensed, right, through depreciation. It's just the timing. So here's the other interesting thing. The depletion cost for a period is the unit depletion rate, and that's just the rate calculated here, right? However many dollars per barrel of oil, times the number of units extracted in the period, times number of barrels of oil, right? Nothing surprising. But that actually gets held in inventory. The debit moves from the natural resource to inventory because we are in the business of selling oil or selling coal, right? A little bit different than our depreciation expense, which is expensed immediately. This ties into the last chapter, whereby when do you expense inventory, right? Only when you sell the item, right? So in this case, if we produce a certain number of barrels of oil and we have them sitting in a warehouse, that's still inventory. We don't expense. But we're moving the cost from the natural resource, we're depleting it and putting it into inventory. Only when we sell those barrels of oil do we realize the cost of sale versus the unsold inventory. Make sense? This sort of brings together depreciation and inventory. But now this is specific to natural resource businesses. You don't see this in most other businesses. Now that being said, specialized plant assets might be required to extract the natural resource. These follow the traditional depreciation rules. So this big mining truck wouldn't form part of the cost of the mine. But it would be depreciated just like any other piece of equipment would be. Right? So it's only cost related directly to the natural resource. That's it for tangible assets. Intangible assets are a little bit trickier to get your head around because you can't touch them or see them or feel them. Okay, so these are non-current, meaning long-term, long-lived assets without physical substance. The useful life is often difficult to determine. So sometimes the law will say copyrights last for 50 years or this patent lasts for 20 years. But it's not always clear how long a trademark will last, right? Or a brand. What's a brand worth? What's Coke's brand worth? Who knows, right? How long will it last? Who knows? The intangible asset is only valuable because it provides exclusive rights or privileges. If anybody could open a pop company and use the Coke brand is worthless. It's only worthwhile because it's copywritten and no one else can use it, right? It provides the exclusivity. The copyright provides the holder with the exclusive right to use the Coke brand. If you have a license to operate a university, or if you're a doctor, for example, you need a license to operate, right? You need to have gone to med school. You have to be licensed by the College of Surgeons of Ontario. That license, therefore, is valuable because it allows you to earn $500,000 a year as a doctor, right? If anybody could walk in and say, I'm a doctor now, without any licensing, well, what's the value in being a doctor, right? These are recorded at the current cash equivalent cost, including the purchase price, as well as legal fees and filing fees. So again, you have to file a copyright or file a patent. You might have to go to a court to defend your patent, right? Remember, two types, definite versus indefinite. Definite life intangibles are amortized. This is the same as depreciation. The word is just different. The concept is 100% the same. Physical assets depreciate, intangible assets amortize. The word mort, that's death. So that's where that comes from, amortize, amortization. The rules for amortizing definite life assets is over the shorter of the either economic life or the legal life. So if the legal life is only 2 years, but you think the economic life of this patent is 10 years, you have to depreciate it over the 2 years because it expires by law in 2 years. Even if you could use this patent to generate revenue for 10 years. These use the straight line method. Indefinite life assets are not amortized. Okay? But because they're not amortized, they're tested for impairment every year, at least annually. All right, this is a bit of a challenging concept. Again, you only need to know high-level conceptual. If you've read this slide, you'll be okay for the final, I'll put it that way. So, goodwill. You might have seen this term thrown around. Goodwill, this is not like the clothing store where you donate or whatnot. Goodwill arises when one company buys another. Okay, and it represents an intangible asset. Goodwill is measured as the amount by which the purchase price exceeds the fair value of net assets acquired. What does that mean? So when one company buys another, you're only going to pay what the business is worth, right? If you're Coke and you want to buy Pepsi, and you think Pepsi is worth $1 million, you're going to pay the current shareholders of Pepsi $1 million. Let's assume there's no debt. Let's just say the Pepsi's balance sheet is $1 million of cash and $1 million of common equity, and you say, I think your business is worth $1 million, so I'll pay you $1 million. So the way you would price a company is you look at the market value, the share price, right? You might run your own analysis and say, I think Pepsi's worth $1 million. The problem is the accounting value is almost never $1 million, okay? The reason is this. As businesses build their operations, they generate intangible assets that are hard to measure, like Pepsi's brand. If you're a company and you start a brand from scratch and you build it up every year, you advertise, you're good to your customers, you have really good prices, people keep coming back to you because of your brand, right? The accounting statements nowhere reflect that brand value. And that's because the accounting rules are such that unless you've paid for something, unless you buy the brand, you don't get to recognize it on your balance sheet. So let's say we were to go to Pepsi's balance sheet and we were to see maybe some property, plant, and equipment, maybe some accounts payable, we have some cash, and let's say all that totals about $1 million, but Coke is willing to pay $2 million for the assets of Pepsi. Why on earth would they do that? Well, you have to admit that the balance sheet doesn't reflect what the company's worth. Maybe that property, plant, and equipment is more valuable. Maybe they have some really valuable land in downtown Toronto, right, that they bought 20 years ago that's never appreciated. Pepsi has a brand value, right? People know the Pepsi brand. You could extract a lot of value by owning that Pepsi brand because customers will pick your brand off the shelf rather than another, PC brand cola or something, right? So companies pay the market value, which is usually greater than the book value. The book value is just the accounting value, the shareholder's equity value on the balance sheet, which is not what the company is worth, right? You've noticed that accounting is sort of built up with all these rules. It's very standardized, but nowhere do we say this is the fair value of the business. This is what someone else should pay to buy this business, okay? So Let me come back to those. So RPEC company paid, actually, let me go back to this one. All right. The buyer gets all of the assets, but in some cases, it takes on some of the liabilities. When a buyer takes on liabilities, it reduces the amount it'll pay to the seller for the related assets. This is just the accounting equation. This is assets equals liabilities plus equity. If I were to purchase a house worth $1 million, I'm going to pay $1 million, right? If the house comes with a $400,000 mortgage, okay, let's say I'm buying a house from you, and you say, can I transfer my mortgage to your name? You take the $400,000 mortgage and just give me 600 grand. Okay, I've still given away $1 million worth of economic substance. I gave you 600 grand cash, and I assumed a $400,000 loan. It's the same type of transaction as if I went to the bank for 400 grand, they gave me cash, I used 600 grand of my own cash and paid you $1 million. What position am I in? Net assets are 600 grand, liabilities are 400 grand, the asset is still worth $1 million, right? So the way companies work is companies often have bank debt, right? Quite a significant portion of bank debt. Maybe 50% of their balance sheet is bank debt, and 50% is shareholders' equity, and then $1 million, or the 100% is the assets, right? When one company buys another, they usually don't buy all of the assets. They usually buy the common equity. So that's how startups work, right? Have you ever heard how startups get bought out by Uber or by Facebook or by Google, right? If we're all the shareholders of ePhone and Apple says, okay, we'll buy you guys out, rather than buying all of our operating facilities, right, they might say, we're going to purchase the shares from all of you guys, okay? So they'll give us cash for our shares. We'll give them the shares. They'll now have ownership. They'll have voting control, right? They'll be able to elect the board of directors and hire the managers, right? Let's say the company also came with 10 grand of debt. It's hard when you're just buying shares. The bank doesn't really care. That bank's debt is still there, and the bank's debt still ranks senior to the shares. This transaction is almost external to ePhone, right? ePhone itself, its operations are unaffected by the fact that the shareholders are selling their shares to another party, right? The bank debt is still in place. So the acquired, or rather, debt is taking on debt is looked at as a form of payment due to the accounting equation. If you start with the assets, right, if you're acquiring all of the assets, you need to pay cash for the equity, and you now need to take responsibility for paying those liabilities in the future. So here's an example. RPEC company paid $2 million to purchase all of the assets, and we assumed liabilities of 400 grand. How much should we have paid for this business? Well, okay, let's see. The assets are worth 1.8 million, right? The debt sitting on the balance sheet was 400 grand. So the net assets, or the equity, was only worth 1.4 million. RPEC, for some reason, paid $2 million. So either they're not very intelligent, or there's this intangible asset called goodwill. Now, goodwill, what does it represent? It's sort of everything else that the business has done that makes it valuable that's not recorded on the balance sheet. And I know that's not a good explanation, but it's sort of just meant to be a catch-all. It's its brand value, its public image. It might have a really strong management team. It might have really good hiring practices. It might have really strong geographical exposure, right? It might have access to markets that other companies don't. These are all true assets in a business sense, But the accounting rules don't let you record them because they're very hard to measure before there's a transaction. Okay, so in this case, we're saying the book value, the net assets were only worth, the shareholders' equity on the balance sheet was only worth $1.4 million. The shareholders were paid $2 million, okay? So what does RPEC record? So RPEC now is acquiring an asset. Debit asset, credit cash for $2 million, right, from RPEC's perspective. So how does it balance this accounting equation? It's going to record the fair value of assets on its balance sheet. It's going to go debit fair value of assets $1.8 million. It's going to credit the debt that it assumed for $400,000. And it's going to debit goodwill for $600,000, such that the accounting equation balances. It's going to be debit fair value of assets 1.8 plus debit goodwill 600,000, saying the asset side, the left-hand side, this whole business is truly worth 2.4 million. Okay, it has this goodwill that was never reflected on the balance sheet, but nonetheless, which I'm willing to pay for. If you look at any acquisition, the vast majority of acquisitions of one company by another company occurs at greater than the book value in real life. So this actually happens because, of course, the companies are worth more than just what's on their balance sheet, right? Because Coke never got to realize its brand value on its balance sheet. Okay, and then so the left-hand side of the accounting equation, the left-hand side of the balance sheet, the asset side is 2.4 million. The credit side of the entry is debt assumed for 400,000, and then cash paid for 2 million. And now we're at 2.4 million on each side. So here's why we don't recognize goodwill. So you might make the argument, well, every year we should record maybe some intangible value, right? Well, it becomes hard because, A, how do you measure it? Right? Look at how much trouble we have with depreciation expense, which is an estimate, right? We're not really sure how long the asset's going to live for, what the residual value will be. We're making lots of estimates there. Can you imagine trying to quantify or measure goodwill without an actual transaction? An actual transaction is a really good indicator of value because another third party is willing to pay us $2 million for our assets. You have to assume that they've done their homework, right? There might be multiple bidders. Maybe there are two other companies willing to pay us 1.9 million. Same way, you don't really know what your house is worth until someone is actually willing to pay you that, right? You might think your house is worth $2 million, but would you go out and max out all your credit cards because you know your house is worth 2 million? Well, maybe not. What if an offer comes in, it's only 1.8 million, right? So you don't really know until someone is willing to pay you cash for it. So that's why we have to wait until an acquisition to recognize goodwill, because it's really hard to measure these things or to account for them. And also think of what the journal entry would look like. It'd be debit goodwill, and what would you credit? Maybe equity, shareholders' equity. Would you credit revenue? Would you credit, and it doesn't really make sense, right? To recognize these things. It's all happening in the background, but there's no exchange of cash. So the accounting rules don't like it. Okay, so these are just some examples. I'm not going to go over all of them, but you have trademarks and copyrights. So a trademark is, like the Visa brand. Copyrights, like books. Patents. Remember how Apple and Google got in that big legal fight over patents? And they were trying to patent like a curve on a screen, or like the ratio of like screen to non-screen on a phone, like all these ridiculous things. But those patents are what give someone exclusive right to manufacture something, right, with a specific design. Technology. Software, website. These are all intangible assets, right? They all generate revenue. Franchises. I'm not sure if you're aware of the franchise model, but things like Subway, Pizza, Subway, these are all franchises, meaning the Subway parent company doesn't actually own each of the individual Subways. If you want to start a business, you give Subway $300,000 and they give you the right to operate their franchise. So that's a franchise license. and then you give them 2% of your revenue or 3% of your revenue. So it's not a very good deal. I don't recommend you do it, but that's how franchises work. So you pay for the franchise license, right? And you're paying for effectively like a turnkey operation, right? Imagine trying to start your own sandwich shop. That'd be hard. Like, you need to figure out how everything works, but you also don't have the brand, right? If I'm walking down the street and I want a sandwich, I'm more likely to go to Subway than I am to your random shop, right? So you pay effectively for you can start day one a Subway sandwich store. Everyone knows your brand. People will come in, their standard pricing. They handle the advertising revenue. They handle the shipment of all these standardized, food products to you. You're just sort of like operating the business. Leaseholds. So a leasehold is the same as rent, except usually it's long-term and usually it's commercial. So leasehold will be, if you work in an office, chances are that your company is leasing that office space from the owner of the building, right? They might lease 3 floors for a 10-year period. Same as rent, same as you renting an apartment for a year, it's just longer term and more space. Okay, so that's called a leasehold. Leasehold improvements. So I know it sounds a little odd because if you and I were renting an apartment, we probably wouldn't put a ton of money into it, right? We're not going to renovate the kitchen if we're leaving in a year, right? Because all that benefit goes to the landlord. Office space, you might lease the space and you might actually be willing to put in $1 million to refurbish it because you're going to be there for 10 years and you have clients coming in the door in this office space. So you're going to redo the bathrooms, you're going to redo the common area, you have to buy new furniture, right? These are all called leasehold improvements. These are long-term alterations made by the lessee. The lessee is the party who is paying the rent to the lessor. The lessor owns the property. The lessee has the right to use the property. And that money spent is depreciated just like any other asset. Okay. Research and development. So if we're a biofarm company and we're researching drugs, it's hard to say whether that research will actually ever materialize into something, right? You might do 5 years of research and get nowhere, or you might do 5 years of research and develop, a great cure to a disease and sell the drug or the patent for billions of dollars, right? So if this intangible asset, meaning let's say that all this knowledge behind how to produce this chemical compound, this drug, if an intangible asset is developed internally, the cost of development is recorded as research and development expense. So some people don't like that. They say, if I'm in the biopharmaceutical industry, all I do is research and development. It might take me 10 years before I come up with any product, right? So some analysts, when they're looking at these companies, treat R&D as an asset. They move it from an expense, they reduce expenses, and they increase the asset, right? To say they're investing all this time and money. The accounting rules say it's not really an asset because it's not probable that it will provide future economic benefit. Think back to the definition of an asset, right? It's possible, and so I don't know the numbers here, but maybe only 10% of the time does that research result in something that is that can be marketable, right? In a new product that will generate revenue. So the accounting rules are conservative and they say you have to expense it all because you just don't know. If eventually you come up with this patent, maybe you can start capitalizing costs related to it once it's in advanced stages, right? There are specific criteria, we're not going to go over them, but under specific circumstances, these development costs can actually be capitalized as an asset and then amortized over time. This is nothing new. Depreciation doesn't require a cash flow, but depreciation is tax deductible. So it produces a tax shield since it saves tax. Cash flows, nothing new. We covered this in chapter 5, I think, with the statement of cash flows. Right? Depreciation and amortization you add back to net income. Gain on sale you subtract. Loss is the opposite. An impairment loss, the journal entry for impairment, and you don't really need to know this, but is going to be debit impairment loss, credit accumulated depreciation, or just credit the asset, non-cash, similar to depreciation. Because remember, if we assess, okay, we paid 10 grand for this equipment, we're going to write it down in a couple of years because we realize we're never going to recover the amount of the carrying value, cash still hasn't changed hands. We paid the 10 grand for it way back when. And then purchases and sales of long-lived assets. Nothing surprising there. All right, that's it for chapter 9. So I'll give you guys 10 minutes to pack up if you want, and then we'll go through some questions. No class next week, of course, because it's Canada Day. All right, thank you, everybody.